Welcome back to Small Caps, ladies and gentlemen. My name is Kerry Stevenson, and today I've asked the Executive Chairman of Boss Energy, Duncan Craib, to come and chat to us. Why? One of the most exciting uranium stories on the ASX at the moment. The ASX code is BOE, and they've just had some key approvals. There's lots of news. Last time I spoke to Duncan was at the beginning of June. We are just getting in, just my opinion, into a massive uranium bull cycle, I think. But let's talk to Duncan and find out what they've been doing at Boss Energy. Duncan, great to see you again. Thanks for joining me on Small Caps.
Thanks, Kerry. Thank you for having me back on the show. Good to see you too.
Yeah, the last time we spoke, we talked about front-end engineering. We talked about the final investment decision. But as I speak to you today, you've had some pretty big news come through. Let's just share that with our audience.
Thank you. The big news really last week was to get the final PEPA environmental approval through from the state government of South Australia. So we've been working closely with South Australian government, as we do, really over the last 12 months to get these environmental permits approved. In uranium mining, it's one of the most heavily regulated commodities to mine in Australia, so it's a key document. We already had our approvals on the existing mine site. What the new approvals do is it approves those extensions that we're doing to basically enhance the mine, that's such that we can increase the production throughput and lower, make it a more efficient sort of operation. So by that, we're able to increase our production throughput up to 3.3 million pounds. It takes into account our wellfield development, and it takes into account ion exchange, which is the new processing method that we'll be adopting. So wonderful to get that news through as we're going through the development stage. We were confident it was going to come through, but it's always a ringing endorsement when state government works closely with the company, as fortunately South Australia does.
Yeah, I was going to say, for those that don't know, this is the Honeymoon mine down in South Australia. Just in case you're going, where's Boss Energy got their assets? So it's Australia, South Australia, more importantly. You mentioned ion exchange just then. What does that mean? Is that a new process that's more environmentally friendly?
It actually is more environmentally friendly. What it is, really, there's two methods for in situ recovery to process uranium, and that's solvent extraction, which is what Honeymoon historically was built on. But ion exchange, we've adopted this technology. What it accounts for about 60% of the world's current supply of uranium. Throughout Kazakhstan, for example, all the operations use ion exchange. In Wyoming and in America, it's ion exchange. Ion exchange allows you to basically have the columns put at the front end of the processing plant. Within the columns lie microscopic sort of resin beads that attract the uranium to the resin beads. The resin bead, having attracted the uranium, grows in size through gravity, falls to the bottom of the column, and then we extract that resin bead with the sort of uranium loading, and then process it through the precipitation plant and then through the drying circuit. So it's just a far more efficient, simpler process to use. And that's really been one of the key breakthroughs that we've had over the past few years with Honeymoon, is that finding a resin that could cope with our environment, our geological footprint with the chloride levels. And, working closely with ANSTO, Australian Nuclear Science Technology Organisation, we found a resin in 2017 to do just what we want, really, achieve greater efficiency and lower the operating cost.
Lower the operating costs. Now, before I get into operating costs and inflation and all those fun things, you mentioned Kazakhstan a moment ago, and I was just thinking in my head, is Kazakhstan, how much do they supply of the world's nuclear fuel? And with the Russia-Ukraine situation, does that mean people are a little bit concerned about getting supply from Kazakhstan and are looking more to someone like Boss Energy being in South Australia, great jurisdiction?
Yeah, they are. I mean, particularly in the Western utilities, so Europe and America, they're particularly concerned about sort of Kazakhstan material and Russian material, but for sort of two different aspects. Well, we're entering into a bifurcated market. It's basically splitting up between the Russian sort of bloc, the Eastern bloc, to the West. And the reasons for that is Kazakhstan basically produces about 50% of the world's supply of uranium. The concern with Kazakhstan is how they actually ship their uranium around the world. So up until now, they've always shipped through Russian ports, and with sanctions being applied against Russia, they're having to find new methods of transporting that material. So they're pioneering through the Caspian Sea, going sort of westward. But yeah, that's the concern. So effectively it's a large amount, 50% of the world's supply. So what that's done is it's shaken the confidence of fuel buyers around the world. Are they going to get their material from Kazakhstan, or do they need to look further afield to safe jurisdictions such as Australia or Canada, for example, to secure that supply? So that's Kazakhstan. Russia, on the other hand, produces more enriched material. I think they do about 5% uranium production, but it's largely enriched material, which is about 40% of the world's supply. Now, that is at risk. So if there's less enriched material being supplied on the market, it leads to what's called overfeeding, which is when more primary production is required, which is for different reasons, but it's to our advantage that suddenly lower enriched material leads to the need for new production. And that's why the uranium price is still holding firm and set to increase. And it's why it will benefit Honeymoon coming into production.
It's interesting you mentioned the price of uranium. I was talking to somebody recently about the different currency. I mean, poor old Aussie dollar is a little bit further down the track than it was when we last spoke in June, which is amazing. And I know that you secured some supply, some yellow cake, if you like, a little while ago. What I want to talk about, Duncan, is the inflation. Is that having an effect on the costs for the project? Are you on budget? Are there any challenges there when it comes to that?
Inflation, absolutely. We've got to watch that continually. So I guess, just to start with, we've got a somewhat of a natural hedge against Forex risk, given that the yellow cake that we purchased, £1.25 million in March last year, that's held at the Confidine conversion facility in Illinois, North America. It's valued in US dollars, so it's a good holding state against the Aussie. And the plan has always been to use that inventory during our ramp-up period, so years 1 and 2, 2024, 2025, giving the fuel buyer confidence that we can sell into existing contracts or take advantage of that Forex and rising uranium price. So that's really pleasing. On an inflationary...
Hang on, before you get onto the inflation, you said just over £1 million of the yellow cake. The current price is $49 US. What did you buy it at? That's what I want to find.
No, thank you. We purchased that at 30.15 US per pound. So it's been financially, it was a good move. But the primary reason was just to give us, when you enter into negotiations with fuel buyers, if we can tell them while we ramp up our sort of production, sometimes there are hiccups with any mining operation, but we can give you the confidence that if there is a hiccup, we'll supply you off our physical inventory that's held in North America. So it just gives you the ability really to negotiate as if you're an existing producer, really. And that's what we're aiming to achieve.
So it kind of gives you that added advantage where they can't knock you around too much, Duncan. You can turn around and say, hey, step back.
Absolutely. That's the plan. Yeah. And I must say, that's the experience drawn upon. We thought it was financially a savvy move. We could see Sprott at the time buying, but, there's the like of your directors stepping in. So Sashi Davies, a strategic advisor who's been in the industry, this is the 4th cycle she's been through, saying it helps so much negotiating with off-takers. Wyatt Buck on the other side, who's got all the operational experience, said, he's been through commissioning mines, there are hiccups involved, and they're under pressure to supply into contracts that have been negotiated. If only he had a bit of reserve sort of inventory that he could supply and keep the customer happy. So it was wonderful. It was sort of looking at it from different facets. Mm.
Well, that's very smart, and I liked, and I did want our audience to understand a little bit more about why you did that, especially with the Australian dollar coming off. Inflation, is that impacting you guys at all?
Well, we're very much aware of it. So far, so good. I mean, majority, I think 70% of our spend is actually of CapEx, that is, to come into production, is spent with Australian suppliers, which we're very proud of. The largest, I think the inflationary pressure will largely come through remuneration to contract or payments to contractors while we do the actual construction of the sort of enhancements that we're making to the mine. So the approach that we're taking is really to now, we've placed, I think, 70 orders now on long lead items to get all the equipment onto site. Once all the equipment's onto site, then bring in the labour force to do the construction. So instead of doing step by step, phase by phase, really, let's get all the materials to site. Once they're there, the most efficient thing to do, bring the people on, build it. And so hopefully we'll keep a tab on inflation that way. But I mean, also bear in mind, if inflation is affecting our costs, it's also going to increase the CPI on which your contracts are negotiated against. So if I enter into a sales contract, it's inflationary adjusted as well. So it's kind of, costs may be going up, but you'd hope, your contract's also protected in that way. So yeah, it sort of somewhat offsets itself, but very much in the foremost of our minds, and we're doing all the best we can to manage our costs.
You mentioned construction a moment ago. I'm talking to you in October of 2022. Give us some timelines so that people can get a sort of a visual idea of where you're going and when you're going to potentially get construction.
It's exciting. I mean, when we look at, so what are we trying to do? So Honeymoon's an asset, brownfield asset that previously produced and exported uranium around the world. We know that. Now we're introducing ion exchange. So one of the largest CapEx spend is ion exchange. It accounts for the columns themselves, accounts for 14% of the CapEx spend of 113 million. So we have placed that order. It's committed, it's honoured, it's within budget, within the feed schedule. So that's a really good win to start your CapEx spend. You know that the biggest item is covered in line with your expectations. So that's positive. The next part of ion exchange are those resin beads that sit within it. So we identified with ANSTO the superior resin back in 2017. We also have been looking over the past sort of 2 years, what other resins are out there? Can we keep further technical enhancing this type of product? And we're not there yet, but we're pretty happy with some of the other resins that we've tested with performance improvement. And what I need to do the study and what benefit that will have, but should it pan out as we think it will lead to more operational efficiency and lowering of costs. So all the meanwhile, with reagents and costs, you're constantly looking at better products, better resins that we can use. So ion exchange as a key component is looking good. So that's the major sort of, pillar of what we're trying to do with this plant enhancement. The second aspect is wellfield. We've now drilled and cased 30 holes on the actual wellfield out of 82. So there are 3 wellfields that we're bringing on for the first few years of of operation. We're nearly, 40% way through the drilling and casing. That's been a primary focus over the last 3 to 4 months. So that's coming along very well. We've also got contractors on site who are now looking at the wellfield construction, the pump houses that sit above. So again, Aussie contractors taking care of that. Then we look at the water treatment plant, really exciting. That's been ordered. Again, Aussie manufacturers, that's being delivered early next month in November. Oh, so wow. That's on time and on budget. And finally, the fourth element were the kilns, the 2 kilns that we've ordered, high temperature kilns that can basically calcine the product at a higher temperature to produce U3O8, which is the best type of uranium production that you can achieve rather than the old UFO4. So those kilns are due for delivery on site early February. So they're the 4 key aspects. Other than that, the plant works. I mean, we've done the camp refurbishments done, the access road's been upgraded. We're working now with the power, increasing our power supply agreement, locking in those prices now before the expected increase next year. It's quite disciplined in approach, but That's the benefit of what we're doing. We're self-performing. We're not basically doing one large EPCM to a third-party engineering firm. We've got those engineers in-house with the experience within uranium team, and that's key difference, self-performing. It puts added pressure on the team, but so far we're on track. We're within budget and we're on schedule.
You're on schedule, on track. Talk to us about the money in the bank at the moment, and does that take you right through to production? So from I guess, an investment point of view, do you need to go back to the market? Are you set so that when those contracts start to come in, you're good to go?
We are good to go. I mean, so right now we have, I think it's 130 million, maybe slightly less than 128 million or thereabouts in cash on the balance sheet. In addition to that, we have the physical inventory, which is also a liquid asset, and that's valued at around 100 million. So let's say liquid assets being cash, the physical inventory, 230 million on our balance sheet. The CapEx spend is 113 million. So we're well covered. We don't need to go back to the market to raise money. That's one of the key objectives we had with the way we're approaching the CapEx spend. If we were forced to enter into debt and we had to raise debt, as I think other development projects would do, to secure the debt, you have to pin it by locking in offtake agreements. We didn't want to lock in offtake agreements at a low uranium price. We fundamentally believe that the uranium price will rise. So why lock it in now? We want to keep developing the project and have that first mover advantage, be there for when the uranium price really overshoots in those initial years of a new cycle. But we're keeping our powder dry. So now we equity raised the 125 million in March of this year. It's allowing us to get the mine into production by the end of next year. That should coincide the start of the new mining cycle, and then we can really take advantage of contracting the majority of our production at higher prices. So there's quite a bit of strategy involved, but we're taking advantage of the fact that we're a restart project, fully permitted, strong balance sheet, and the right skills and personnel to take it forward.
Goodness me, it's quite exciting. I feel like the last time we spoke, there was stuff going on, but now in talking to you today, it feels to me like good custodian hands that is literally you know what you've got to do. You don't need to go back to the market. Question I have is, right now the price is $49 USD for uranium. That's the spot price. How do you manage if that spot price goes to 56, whatever it goes to? How does that work when you lock in contracts, or do you not have to lock in the price? How does that work?
Okay, that's a good question. So really, with the price in the doldrums over the past decade, it's been a buyer's market, and the buyers, being the fuel buyers or the utilities, have insisted upon fixed price contracts. So one price fixed with an inflationary adjustment as the years passed. Now that market has changed to being a supplier's market. So what the suppliers like ourselves or producers are insisting upon is a market-related contract. So market-related contracts basically have a floor and a ceiling. So, for example, we may insist upon a floor of 45 or 50 US a pound at that level. The buyer would say, okay, but then if we have a floor, then a ceiling would be around 75, 80 US a pound at current prices. What that means is that it's then correlated to the spot price. So within that boundary of the floor and the ceiling, the spot price will continue to rise as we expect over the years to come. At the point of delivering your product to the fuel buyer, so if I'm to enter into a contract now, typically it's 18 months to 24 months for that first delivery. At the time of first delivery, the current price is, say, 49 US a pound, maybe 60 US a pound. That's the price that the customer will accept and pay you upon, because it's within that boundary. So that's how we would enter into a contract now, market-related pricing. And that's similar to how the industry is unfolding. And there's been quite a bit of contracting activity of late, actually. So that's really come off this World Nuclear Association symposium. Typically late October, November are key months in the uranium cycle for contracting. So yeah, it's market related. So that gives us assuredness, and bearing in mind, Sorry, I'm on a bit of a roll here. Our all-in cost is about $32 a pound.
That's what I was going to ask you.
$45 a pound as a floor gives the project sustainability. So that it takes into account if there's foreign exchange risk or commodity risk or something goes untoward that's unexpected, you've got that buffer. So when you're assessing uranium projects, they come out saying, our all-in cost is X, Y, Z, therefore we can take a contract at that level. That's a bit naive. They should really build a buffer upon that. So it's a really interesting market. Historically, or the past 10 years, the incentive price to bring on new production has been touted at $60 a pound. Right now, it's deemed to be 70 or closer to $80 a pound. So prices have risen for new development projects to come in, and that's why we've got an advantage. We're a restart. We don't have a big capex spend. We've got a low operational efficiency brought upon by ion exchange, and we can really be there at the beginning and be a profitable operation.
Sorry, I'm getting quite excited for you at the moment.
Thank you.
I do have a question just about sort of Russia and, Mr. Putin turning around and saying he's going to nuke the world. Do you think that's going to do an upset for this? I love uranium as a fuel source because I believe that if more of us adopt that, we're going to, A, have a cleaner world, and B, the costs of energy could potentially come off a little bit. But is the Putin sector going to hurt that at all, I guess, is my question.
It's a concern. Yeah, absolutely. It's a concern. I mean, if I don't know. I mean, I don't believe it would happen, but yeah, if there was a nuclear war or such, or the deployment of nuclear bombs, that would be a concern for the industry. Absolutely. It hasn't really affected the new progress being made within the industry. You can look at France going into new enriched material. Yesterday, Cameco came out with the news that they're looking to acquire, or they are going to acquire Westinghouse, which is a sort of $7 to $8 billion US deal, which brings in sort of enriched material and capacity. The world's crying out for uranium, as you rightly say, and it's really, I always maintain that, it's part of the mix. It's part of the energy mix. It provides base load carbon-free power. So by that, of course, we want wind, hydro, solar, etc., renewable projects, but they are seasonality dependent or they're weather dependent, whereas nuclear can provide that baseload power. So it's got a role to play, and the world adopts it. I mean, it currently accounts for, I think it's about 22% of the world's supply of energy. So it's a ready supply uranium source and source material. So, and that's where the producers come in. That's where we're there to help supply. At the World Nuclear Symposium in London, early September, there were about 450 delegates. It was a fantastic turnout. And what was really pleasing for me is a lot of the delegates who were there were actually engineers and delegates from small modular reactors around the world. So that downstream part of nuclear were so well represented. And it just shows that's where the industry is growing, that downstream processing. And it's hugely exciting. Now, where are those new SMR builds going to get their uranium from? Where's that primary production going to come from? So the cycle worldwide is terribly exciting. Yeah, really, really good.
I love your passion, but we're running out of time, Duncan. So listen, let's get you back on early in the new year. But for now, what I'd love to do is just get 3 reasons, because that was a fantastic overview of where Honeymoon are. And I applaud you for doing it in such a, a methodical way to make sure that you've got everything. And to me, it sounds like shareholders will benefit in the long term for how methodical you have been in getting this restart done. But the question for you is 3 reasons why you think right now our community.
Thank you, Kerry. I mean, just on shareholders, look, be reassured, we're fully funded. So we are fully funded to go into production, as mentioned. 230 million liquid assets with 113 capex spend. So we don't need to raise more capital to go into production. So that's really reassuring for shareholders. And I think a lot of mines, irrespective of the commodity, often underestimate their working capital requirements once they commence production and typically raise more funds or seek debt finance around that initial period, but we don't have to. We've got that physical uranium there, so we're covered. I think the second part is really by coming into production, we've got that first mover advantage. So we're there at the start of a cycle, ready to take advantage of the increase in uranium price and lock in contracts at higher prices before all the other development projects seek to come into production. So that's the benefit of backing a restart project. I mean, and thirdly, what's really exciting and something that we're going to continue to really expand upon is our sort of extension of mine life, our exploration assets. Only half of our JORC resource is included in our mine life to date, so 36 million pounds. But there also sits another 36 million pounds, admittedly in inferred and indicated categories that we need to prove up, but they sit on 2 satellite domains on 100% owned tenement ground, ready to be incorporated into our mine life extension. And that goes back to the start of our interview, where what did the new permitting approvals give from South Australia? Well, we can produce up to 3.3 million pounds, and we have got engineering plans to actually do that expansion work. We can simply add on 2 more ion exchange columns. We can duplicate the precipitation circuit. We can add another high temperature kiln in. So yeah, it's got room to grow. So yeah, thank you. It's it's an exciting time. It's busy, but we're getting there.
It is busy. I love your passion, Duncan Craib. You're the executive chairman of Boss Energy. As I said right at the start, this is going to be Australia's next uranium producer. Congratulations, and we'll speak to you again in the new year. Take a little break over Christmas, Duncan, but congratulations.
Thank you. Thanks very much.